There are large GPs out seeking record amounts of capital for new fund vehicles.
That's Graham Rose, a senior partner in our private equity practice at the Boston office.
And these are vehicles that both were raising prior to the downturn, as well as some headline GPs who've gone to market even in the midst of the COVID-19 impact.
Today on the show with Graham Rose, we're going to talk about the state of fundraising, the amount of dry powder actually in the private equity industry right now. There's this mountain of capital, about $2.5 trillion, with over $800 billion of that earmarked for buyouts. Those are both record numbers, both twice the amount in the recessionary period we entered 11 or 12 years ago. I spoke with Graham Rose to put that into context with the current fundraising markets.
If you look back at 08-09 and think about the early stages of that downturn, today feels like there is more latitude to raise.
I'm Hugh MacArthur, head of Bain's Global Private Equity Practice, and this is Dry Powder. So Graham, how has, in your view, the fundraising environment changed since this pandemic started?
The fundraising market remains relatively open. Certainly, we're seeing timelines be pushed out a little bit in terms of the raising, but the feedback we're receiving from clients is that the capital is being allocated, it's working remotely, people are confident that they'll get their money, and the question ends up being whether it takes a couple of months longer or whether they can actually hold around the set of timelines they might have established up front. Now, that's true for, call it mature funds or existing GPs with strong track records. I think as you start to work down towards new entrants or new GPs, the picture is very different. There was a headline, for example, that only a small percent of the funds being raised in Q1 were for new funds. So we have seen some impact on the amount of capital that's being allocated to new ideas. And in some ways, that's understandable from the LP's perspective as they look for confidence in the ability of their partners to deploy and deploy smartly, and are looking for people who've got a track record of investing across prior disruptions.
So let's unpack this fundraising a little bit. It seems a little counterintuitive to me. Firstly, we all heard that there was a denominator problem that many LPs faced, in that the devaluation of their public equities would cause them to be overallocated mathematically to private assets. We've seen recently a resurgence in the public markets and also obviously some portfolio markdowns on the private asset side. Do you see that the denominator effect is now largely not inhibiting LPs from being able to make new commitments?
I think there are a series of factors going on, one of which is that the LPs don't want to miss out on what they saw as boom vintages raised in the last downturn. The LPs looking at this environment today don't want to be on the wrong side of that. So there is a predisposition to lean in a way perhaps that wasn't apparent in the last downturn.
But do LPs really have the ability to lean in? I mean, I guess the denominator effect may be ameliorated by recent marks in the public and private markets, but we've also heard there have been some liquidity issues for LPs as they've been asked for more capital to shore up portfolio companies. So do you think liquidity is an issue here, or is there just enough dry powder in the market to be able to overcome that?
It's a great question. I think there are certainly LPs who are having liquidity issues. There are family offices in the tail of institutional investors that will have to look hard at what their expectations are in terms of cash flows over the course of the next 12 or 18 months. There are certainly also investors who are struggling with local dynamics, such as currency exchange rates, the guidance from their board in terms of cash flow demands that they may need to meet. However, I think your point around the rebound in the public markets is a very good one. Even as the private markets have moved down and you've seen public markets rebound, a lot of that pressure has been offset, though I think that the discussions at the LPs, and certainly among clients that we know, took place even earlier. They were talking about the potential for a disconnect between the private market valuations and public markets coming back well before it actually happened. And in many cases, trying very much to get ahead of that, trying to get permission to maintain a forward foot into the marketplace. Not everyone could do it, but I think that that is one of the differences between what we're seeing today and perhaps what we saw in 08, 09, was that people were actively trying to stay ahead of this from the LP perspective.
In this moment of extreme uncertainty, you're confident that LPs are actually receptive to funding new deals without understanding what the virus is going to do. Is it going to come back? Are we going to have massive waves of reinfection, second waves, third waves, et cetera? And why would that be true?
There's a couple of reasons, one of which is born in the lessons of their actual observed cash flows. The lessons of prior downturns would suggest they're committing for cash flows that are several quarters, if not years away. The pace of that demand will be in no small part dictated by underlying deal activity and ultimately by the shape of the recovery. The conversations that we've had with clients suggest that this understanding that I am committing for the next few years, ultimately, I can't predict what's happening with the pandemic. I can't predict what's going to happen with the economy underneath it or around it. But what I can say is that the pace of activity and the pace of my capital deployment is likely to move with the recovery rather than move through the downturn and leave me in a position where I've just committed and can expect rapid cash draws in a period where I can't make those happen.
You've mentioned that many investors have absorbed the lessons of 2008, 2009, and actually those were great years to invest. It seems this time around, because of a lot of the uncertainty, some in the investment community are thinking that we could see depressed multiples, depressed pricing, difficulty in earning return struggle on for several years. Are you seeing a case where multiples bounce back faster than that, or do you think that we may be in for a prolonged downturn?
There is, as mentioned before, a record amount of dry powder, and certainly that suggests that there's going to be a lot of competition for any deal that emerges. There are reasons to believe that any transaction that gets priced today will be priced fully, given that degree of powder was circling around. We've also observed this, certainly among our clients, as the market has started to see more activity in the form of pipes, structured products. A lot of different players and capital are trying to put money to work, pushing the multiples and the frothiness in the transactions themselves. There may be a window of opportunity for favorable pricing, but it's going to be favorable pricing in light of a competitive situation with many different bidders looking at any asset that they feel they can deploy capital against.
I think you're right that there's a case to be made that this could be an even faster rebound, albeit with lots of uncertainty around it, than we saw in 2008 and 2009, because as we talked about earlier, I think things are just fundamentally different now, and this is a fundamentally different downturn. When you think about the downturn of 08, 09, we had massive structural problems in the global economy. We had an over-leveraged and undercapitalized banking system that made liquidity difficult to provide. We had asset bubbles like in real estate in the US that were going to take years to work through. We really don't have that right now. There are instances, if we continue to keep economies shut over the long period of time, where we could cause large structural amounts of damage in the economy, and what's happened in economies is now under debate. But it would seem that at least the financial markets are signaling that if we can come out of this crisis in the relatively short term, that we can bounce back to some kind of a new normal. And as you mentioned, assets will be competed against. And I think it's interesting to observe that in the first weeks of the pandemic, we saw a lot of investing on the distress side, credit, pipes, as you mentioned, even some public to private activity that actually was competed. We're now rapidly pivoting towards new processes, largely in sync with where the pandemic started and where it's been and where places are recovering. For example, if we use our Bain book of business as a proxy, we are seeing high levels of activity now in China and in parts of Asia where the virus started. We're actually seeing substantial upticks in business also in Europe now, especially Northern Europe, and more recently, even in the United States. And this is telling me that there's some type of resiliency, that the stock of dry powder, a belief that things actually can get done, and that fundamentally the virus is the problem, not the economy, that potentially we might see multiples and we might see the investment community bounce back a little sooner than some of the pundits might believe. What are you seeing in your own deal pipelines and in your own book of business that might suggest that that's either true or a little bit too optimistic?
No, I think it's very fair. I think the other piece that I would add to the discussion is the sources of capital. we have a far more robust set of private capital to draw upon. And if you juxtapose the prior downturn against today, a lot of the mid-market loans and leverage situations were financed by the banks prior to the downturn. And then during the course of the financial crisis, they got out of the business in a large way. The capital commitments that they would have had to make to continue those lines of businesses, various strategic decisions, a host of factors. Today, a lot more of the activity in the leveraged loan market is supported by actors who either have closed-end funds behind them, have different pools of capital in the cases of some of the large pension plans, but don't necessarily have the same degree of constraint or are more resilient, given the fact that, again, the nature of this crisis is different, given the fact that the pool of capital is different. And so to your point, yes, my own deal pipeline back in March was very much around secondary trades in the debt market, people buying debt at depressed prices. It then shifted towards more selective opportunities in the secondary debt market, people starting to take not just broad-based view, but zeroing in on credits, trying to figure out within a given industry sector who was mispriced, and then started to move into the solutions, the structured debt, the private investments and public equities to build balance sheets, to build resiliency. And right now is the first real wave of processes where you would classify it almost as a traditional leverage buyout. These are assets coming to market that are very resilient, perhaps infected on the periphery by the pandemic, generally speaking, would have survived prior downturns very well. But those are things that there are actually leverage packages available against. There is a baseline of credit that you can use and deploy against it. There's a comfort level among those sources of credit that'll get done. And so we are seeing that shift start to happen. Now, how those go and how those proceed, we will know in July. But the fact that people are trying it and trying it not just in a way that is a vague process, but a process that has more firm deadlines, almost the classic way of getting a deal transacted, is a positive sign for the marketplace. And ultimately, to your point, perhaps a harbinger of the resiliency of the model and the set of financing through this situation in a very different way than the last time we were through.
You see, I think that's a very interesting insight that you just made right there, which is that this pandemic, unlike past downturns, certainly 08, 09, is impacting sectors very differently. This is not a question of customers being reluctant to spend. This is an issue of many customers not being able to spend. And there's a big difference in that. And there are sectors that are actually doing neutral to quite well during a period of pandemic because we don't have a lot of those structural issues going on that are damaging the entire economy. And as I reflect on the industry segments that were most popular for investment in 08 and 09, they're different over the last 5 years than they were then. Right now, tech and healthcare represent the top two sectors in the private equity industry, and many elements of those sectors have actually either not been harmed or actually been accelerated in terms of revenue growth through the pandemic and through the ways it's now forced us to live and forced us to work over time. And so your point about the industry structure is different, or looking at different assets, the pandemic is impacting different sectors in different ways, and some of those sectors are underwritable and financeable even by debt is an interesting one. And so I do think that there is a case, again, not knowing the future, no one can tell the future, that suggests that in some of the strongest areas of the private equity market, we may see a return to deal making sooner rather than later.
I think that's right. What I am seeing clients do is pay attention not only to the end market, but then also within it, the revenue model and the stress test of the revenue model. So again, on technology, the software, the recurring revenue, but truly recurring revenues, things that are linked to ongoing subscriptions and perhaps decoupled from exposure to transaction volume. And so being able to actually work through and say, this is a resilient model that we feel good about, both the industry's exposure and then underneath that, the nature of the actual revenue and cash flow streams, And there are sectors that certainly have been much less affected. And I think that as I talk to clients, it's this focus on both how do we think about the shape of the demand curve? How do we map our own businesses against that demand curve? And how do we map the models against that demand curve? And what can we take away from that experience in terms of the types of assets that we would be hunting for?
On the next episode of Dry Powder,
if nothing else, in the next 5 years, change will be faster even than it was over the last 5 years.
Graham Rose and I will discuss sector expertise in a time of great uncertainty and disruption. I'm Hugh MacArthur. Thank you for listening.